We've kind of realized as we've gotten into this space, there's a lot of things that school didn't teach you to become prepared for the real world. And as we become business owners, we've been realized that we've been taught how to be an employee and not a business owner. And there's a lot of things to unpack in this entire conversation, right?
And really the only thing that combines numbers and language to get numbers, language, and law together is tax law.
Hey, it's not this big bad bear that's coming to get you. If you properly use the tactics and the tools that are given to you by the government, you can save a lot and potentially pay way less or none.
It's not just about paying less tax. You will find yourself more successful as a business owner because you're paying attention to how business works and you're paying attention to how real estate actually works.
Obviously, we talk about the different strategies, but like a fix and flip or just flipping a property in general, because then, when the outlay of cash, in 6 to 12 months, you could be replenishing that, right?
The thing about the tax law in the US is it's entirely fair, meaning that two people doing exactly the same thing, exactly the same way, making the exact same amount of money will pay exactly the same amount of tax.
Welcome back to the Wealth Juice podcast. As always, it's your boy Ryan here with another episode. Unfortunately, Corey couldn't join us tonight, but I won't leave the suspense out. We had an amazing guest on the show. Today, I interviewed one of the powerhouses in the tax space. It's the CPA for Robert Kiyosaki. His name is Tom Wheelwright, and many of you may know him as the author of Tax-Free Wealth. Today, we had an incredible interview and talked about his experience working with Robert, and then really broke down the tax incentives for investing in real estate and buying businesses, and really broke things down on a granular level. We also talked a bit about life insurance and his new book, which recently came out a few months ago, actually. It's called The Win-Win Wealth Strategy, 7 Investments the Government Will Pay You to Make. And it really dives into the other side of taxes, like when you make your money, how you deploy it can actually be tax incentivized as well. So that's how we got into the life insurance topic. But it was just a blast to have Tom on the show. He's a wealth of knowledge. He has years of experience. And to be in the same room as someone that rubs shoulders with Robert Kiyosaki on a daily basis and shares the stage with him was just an honor. So his book is really, really good for someone that's trying to learn and understand tax on a basic level, but not feeling overwhelmed. And for my real estate investors out there, I think you're definitely going to want to check out his book. I already mentioned to you the Win-Win Wealth Strategy, but the other book, Tax-Free Wealth, I have a copy of this if you're watching on YouTube, by Tom Wheelwright. So that's who we interviewed today. It was an absolute blast. Hope you enjoy the show, and we'll dive in right now. Tom, officially welcome to the Wealth Juice podcast. I'm so excited to have you on the show. As I mentioned to you pre-recording, we're big fans of yours, Robert Kiyosaki, the whole movement of real estate investing, and then also how to strategically leverage tax and the incentives to obviously pay less in taxes, but to save a little bit of money over time. So you are one of they call them the godfathers in the space or the legends in the space. So we are honored to have you on the show. Thank you so much for joining us.
No, I always appreciate good financial education because it's so needed. So thank you for doing this.
Absolutely. Yeah. I think one of our big goals here, I kind of mentioned to you pre-recording, but over the last 4 years, we've kind of realized as we've gotten into this space, there's a lot of things that school didn't teach you to become prepared for the real world. And as we become business owners, we've been realized that we've been taught how to be an employee and not a business owner. And there's a lot of things to unpack in this entire conversation, right? But it's funny, come through reading Rich Dad, Poor Dad, some of your books, and just getting to know people in the space. There's almost like a hidden world that no one knows about. And so that's what we're looking to bring to life today, specifically with talking about tax and the incentives, and no better person to hear from than you. So with that, if you could just give a brief background on how you became a CPA and even got into the accounting space, and then, parlay that into the businesses you've created today.
Yeah, no, I appreciate that. So I actually grew up in a family business. My dad was a printer. He and his brother were partners. And as kids, we all worked in the business. My mother was the controller. So she was the in-house accountant for the business. And I loved numbers. So I worked in the accounting department. That's what I did in the business. I had a brother who worked in the press room, and another brother worked in the art department. And so we all worked somewhere growing up. And the bookkeeping side was a really good introduction to me of accounting. And then I decided I really like law. as well. And really the only thing that combines numbers and language to get numbers, language, and law together is tax law. And so when I studied at the University of Utah, I had a really good tax professor and actually an undergraduate. And I asked him, I said, so if you were me, he was an attorney. If you were me, would you go into law or would you go into accounting? And he said, well, if you want to do tax, do accounting because you'll do a lot more tax than you would in law, which I thought was interesting. He said, in law, you're going to do a lot of contracts. You're going to do a lot of negotiations. If you want just pure tax, then you need to be an accountant. So I did my graduate work at the University of Texas with a master's of professional accounting and an emphasis in tax. And then from there, I spent 7 years with Ernst & Young, 3 years in their national tax department in Washington, D.C. I spent 4 years as the in-house tax advisor for a Fortune 1000 company in Phoenix, Arizona. Spent 14 years as an adjunct professor at Arizona State University in their Masters of Tax program, and spent about 25 years building CPA firms, and then started a network of CPA firms, and now we have a franchise of CPA firms. So, and then along the way, I met Robert Kiyosaki. He actually became a client of mine through an acquisition, one of my acquisitions of an accounting firm. And we got to be good friends, and we had similar missions. And it turns out that the tax law actually promotes everything Robert talks about. So if you look, for example, at his second book, Cash Flow Quadrant, how you earn your money, ESBI, employee, self-employed, big business, or professional investor, has a significant impact on how much tax you pay. So where employees will pay typically 40% in tax, a professional investor, like a real estate investor, could easily pay zero tax, right? That's why Donald Trump famously said that he doesn't pay tax because he's smart. Well, if he doesn't pay tax because he's a real estate investor. I mean, that's the fact. And he doesn't pay tax. I did see his tax returns when they were illegally released a few years ago, and he clearly doesn't pay tax, and he shouldn't be. In fact, I remember saying when they started talking about him not paying tax, I said, well, he'd have to have the dumbest accountants in the world to pay any tax, because real estate is such a tax favored investment vehicle. The government pretty much says, look, if you put your money where we want you to put it, we will we'll basically partner with you, and we'll contribute in the form of a tax benefit. So that's basically what the government's doing, is they're just partnering with you if you do things that they like business or real estate.
Totally. And I think I want to dive in on this a little bit further. I think a lot of people out there, mainly the W-2 employees, are afraid of taxes because they see how much comes out of their paycheck, right? It almost feels like they're getting robbed every time they go to make money. Exactly. So I want to talk about that. And I know when one of these books that you've written, that you've mentioned the tax code is designed to get people rich. So I want to talk about that and kind of maybe flip the mindset that people have on, hey, it's not this big bad bear that's coming to get you. Like if you properly use the tactics and the tools that are given to you by the government, you can save a lot and potentially pay way less or none, AKA Donald Trump. So take me through that. Take me through, it's how you envision this and in your words, it's designed to make people rich.
Well, so first of all, I think it's important people understand that the tax law is not there just to raise money for the government. It's been used since the 1960s. President Kennedy was the one who really started using the tax law as an incentive. So he started with the investment tax credit, it was a 10% investment tax credit. And then Ronald Reagan stepped it up with real estate and gave us really fast appreciation on real estate, faster than we have now. And then Donald Trump increased the real estate tax benefits through bonus depreciation. So basically, the first thing we have to do is just change our mindset, that go from, look, the tax law is out to get me, to the tax law is my friend. And the tax law is your friend. Okay, the IRS is not. Be very clear. The IRS is not your friend. Not for a second would I ever pretend that the IRS is your friend, and they don't pretend either. They're not. They're not bad people. They're just doing their job, but they're not your friend. The tax law, though, can be your friend as long as you ask the right questions. So I like to say, if you ask better questions, you get better answers. So, for example, people always ask me whether something's deductible, and my response is, well, let's ask a better question. The better question would be, how do I make it deductible? Because if you want to change your taxes, I always say, if you want to change your tax, you have to change your facts. And two people, the thing about the tax law in the US is it's entirely fair, meaning that two people doing exactly the same thing, exactly the same way, making the exact same amount of money will pay exactly the same amount of tax. Okay. But they have to be in exactly the same situation. So sometimes you just need to change your situation. So really, there's about 30 pages that raise taxes out of 6,000, and the other 5,970 pages are basically a roadmap to reducing your taxes. And I do think that they're beyond just reducing taxes. I do think that the best kept secret is that the tax law is really a pretty good guide to producing wealth. That if you literally follow the tax law the way it's intended, you will get richer. I'll give you a perfect example. So I said, if you want to deduct something, then, what do you need to do to make it deductible? So there are 4 tests to make something deductible. First thing, it has to have a business purpose. Okay, well, that's a good idea. If something has a business purpose, I'm more likely to make money. Second of all, it has to be ordinary or typical in your line of business, whether it's real estate, energy, whatever. Third is, it has to be profitable. The goal of the expense has to be to create a profit. And then the fourth thing is, it has to be documented. Well, I could show you, if my clients allowed me, I could show you that every time they spend money that has the intent to be profitable, and it's a typical type of expense to be profitable, like, for example, Google AdWords, for example, or advertising for your tenants, right? Anytime you have an expense that's intended to be profitable, you're more likely to make money, right? So what the challenge people have is they tend to want to cut corners to reduce their taxes. And that is not the way to reduce taxes. The way to reduce taxes is actually to follow the tax law. You follow the tax law, you are more likely to reduce your taxes following the tax law than cheating on the tax law.
100%. And I think I heard this somewhere else that you were guest speaking at, and basically you're mentioning that it's a lot of the high net worth individuals or people that are playing the game at a high level are the guys or gals less likely to cheat the code. And it's a lot of like the smaller business owners or maybe even not even business owners, people trying to cut the corners because the higher net worths, they don't need to. They already have the right people in the right places to help them navigate, which I love. Now, I kind of want to talk a little bit into, so our audience, as I previously mentioned a bit, is either real estate investors that have a small existing portfolio and they're running this thing full time, or they have a portfolio and they're also still managing W-2 jobs while running their portfolio. So I want to talk to these people and just, how would you recommend that they get their tax position optimized, without maybe knowing everything, right, about their situation? And I'm looking for maybe some tips and tricks just as we kind of navigate the subject, because I really do think it seems so complicated for everybody. Just a couple points might help out.
Well, so I'd start by saying, 2 things you need. You need a basic understanding of how the tax law works. And that's why I wrote Tax-Free Wealth and the Win-Win Wealth Strategy. That's why I wrote those 2 books, so that you have a basic understanding of it. And the second thing is that you've got to have a good tax advisor. The reason rich people pay less tax because they have better tax advice. I mean, it's not rocket science. They do have better tax advisors, and they don't have to be expensive tax advisors, but they do have to be people who actually understand real estate. Real estate's a specialty. It's like, for example, if you came to me and said, well, I want to max out my pension plan, I would send you to somebody else. Not my specialty. But you want to max out your real estate tax benefits, I would be the guy for that. Okay. So you really do need a good advisor. This is a team sport, right? Real estate's a team sport, as Robert likes to say. And so I think that's first and foremost. There are some, are there tricks and tips? Yeah, I walk through them in Tax-Free Wealth. You can pay your children to help in the real estate business, right? That way you get a deduction at your high bracket. They don't pay tax because they're in a zero tax bracket for the first $13,000 or $14,000. You can, you have elderly parents who you're supporting. You can have them own part of your business, and they might be in a lower tax bracket. So you can use tax brackets. Tax brackets are important. The other thing you can do is you can convert ordinary income to capital gain or tax-free income. Real estate's a perfect example. So if I had a short-term rental, right, I would have ordinary income on a short-term rental. If I turn that short-term rental into a long-term rental, then when I sell the property, it's long-term when I hold the property for a longer term, it's long-term capital gain. If I do a 1031 exchange, it's tax-free. If I do tax-free exchanges, 1031 exchanges until I die, tax goes away and it's permanent. So there are those, just once you understand, wow, I buy real estate. When I borrow money out from the real estate, I use it as collateral for a loan. I don't pay tax on the loan. When I die, all my taxes go away because that's what happens when you die. We have what's called step up in basis, and the capital gain goes away. So there are really fun, basic things you can do, and real estate's kind of a fun game. To me, the reason I like real estate from a tax standpoint is because it's one of the most fun aspects of the tax law. I think the tax law is a game, right? That's what it is. Now you got to know the rules. You got to play the game right. Okay. Don't be skipping on things. Don't be cutting corners. But if you do it right, it's not just about paying less tax. You will find yourself more successful as a business owner because you're paying attention to how business works, and you're paying attention to how real estate actually works. And you're actually going, wait a minute. So if I'll give you a perfect example. So there are people who will go out and borrow money to do fix and flips. That's a really risky debt. That's like, it's a little bit better than gambling, but not a lot better. Okay. Because who knows if you're going to be able to flip that house, right? You borrow the money to flip the house. What if you can't flip it? Now you're stuck with the debt. But if you borrowed that money and had your tenant pay for the debt, well, that's a lot less risky. Or just look at the last couple of years. You had people who were out there getting interest-only loans, and they were short-term, so they were adjustable rate mortgages. Seriously, it was just like it was in 2006 and 2007, and people got caught the same way they did in 2008. Interest rates skyrocketed. People got caught because they took a more aggressive approach. It had those who had long-term loans, the increase in interest rates didn't bother them at all. So, that's part of it also is, learning the business of real estate. Taxes is just a part of that business.
Totally. So I want to mention Rich Dad, Poor Dad is kind of where a lot of people start, at least in our niche in real estate investing. And I think it just allows you to flip your mindset from consumer to investor and just teaches you how to invest in income producing assets. And I just want to give a plug to Tax-Free Wealth. I think it pairs perfectly with Rich Dad, Poor Dad as kind of a jump into the tax law and the incentives, right? And it gives you, I think, someone left a review for you that I think is one of your most proud reviews, but you said, they say it's a good beach read. And if you can make any tax book a good beach read, I think you're doing something right. And so I've combed through it. I haven't gone all the way through. And I have to say, I've tried a few other tax books and I can't even get past page 30. And that's pushing it. And yours, I'm breezing through. And so I agree with that. And I'm giving you that testimonial from me as well. I think it's well written. And Kiyosaki wrote the forward too. So you guys are like your hand in hand here, and it does work off of each other. I think it's great. You also have another book out there called Win-Win Wealth Strategy. Can you just talk about the two differences in these books and kind of who they speak to and like the frameworks of them, just to know the audience?
Yeah. So I think that there's three questions you have to ask from a tax standpoint. The first question is, how do you make your money? And then, so how do I reduce my taxes on the money I earn? Right. And that is tax-free wealth, right? Tax-free wealth is all about, if you're a business, if you earn your money in real estate, you earn your money in energy. Here's how I reduce my taxes by the money I earn. Win-win wealth strategy is more of an investment side. It's how do I pay less tax by the money I spend? How do I pay less tax based on what I do with my money? So the second question is, what are you going to do with your money? And win-win wealth is all about what are you going to do with your money? Okay, so you have how do you make your money? What are you going to do with your money? So that's why I think we needed two different perspectives. Win-win wealth talks about 7 investments. The government will literally pay you to make these investments, and real estate's one of those. So let me give you an example. So one of the great things about real estate is the income is effectively tax-free because of depreciation offsets the income, right? I call that tax efficient. That's tax efficient investing. And you'll hear financial planners talk about tax efficient investing. That means that you're not paying a lot of tax on the income. Then there's what I call tax effective investing, which is actually getting a tax refund because you invested. So in other words, if I take the money from my business, and Robert talks about this a lot, he takes his money from his business and invests in real estate. He pays less tax on his business income. So it's because of what he does with his money that he pays less tax, not just how he earns the money. So how he earns the money, he's going to get into a lower tax bracket in the first place. But then what he does with it allows him to get much lower taxes because he's putting it into a hard asset like real estate. And I think that's where those two go together. There's obviously a third question, which is what are you going to do with your money when you die? I haven't written that book yet. That's
coming. I feel like it's a trifecta. It's coming soon. So thank you for breaking that down. I want to touch on this because I know it's in the book. You touch on life insurance, and maybe this is a personal one, but I know when people hear infinite banking, they get all excited. They're like, well, this is crazy. This is cool. Is this really legitimate? Can I really build up cash value, draw off it, not have to pay it back? And I'm only speaking because I do have a few different whole life insurance policies. I do have a term as well. Just like I'm playing the game, right? And so I'm learning, like, the further you get into this, it's great to have that option. Can you break that down and maybe just out of the 7 investments, talk to us about, we'll drill down on this just because it's super like a sexy subject for our listeners.
Yeah, no. So that's chapter 7 of Win-Win Wealth Strategy is insurance. And I go through a really comprehensive example that one of my actually close friends who's an insurance agent actually helped me with. And basically what happens is that you have 2 types of insurance policies. I mean, basically you have temporary and permanent. That's really what it comes down to. And term is temporary and whole life is permanent. There are other types of permanent insurance, but whole life is the most common. So with term insurance, that's basically an expense. And it's term insurance less than 1% is collected. So it's really an expense. It's not an asset. But a whole life policy, that's actually an asset. Well, if you have an asset, one of the things you can do with an asset is you can use it as collateral for a loan. Now, in life insurance, it's actually baked in to the life insurance contract. And that's kind of a cool thing about life insurance. It's really the only asset outside of real estate. It's the only asset where the ability to borrow money is baked in. You can think about a life insurance policy very similar to having a line of credit on your home. It's actually very similar. You've got your home equity as collateral, and you've got that line of credit that you can borrow when you need that money, and it's pretty easy to borrow that money. A life insurance contract is very similar. Once you have cash surrender value built up into the policy, you're allowed to borrow from the insurance company. Okay, you're not actually borrowing out the equity of your insurance policy. You're actually using it as collateral to take a loan from the insurance company, just like you would use your house as collateral to take a loan from the bank, right? Very similar. And because of that, actually, you can actually use that money multiple times, right? There's some velocity to that money because it's the life insurance contract is still growing, right? It's still earning interest. Now you're paying interest, but if you're using, let's say you use it to invest in real estate, you get to deduct the interest because it's real estate interest. The nature of interest expense is determined by what you use it for, what you use the money for. So in this case, if you use it for a real estate investment, then you're going to get to deduct the interest. And then, of course, you earn the money and your tenants can then pay back the loan. So you really are your own lender in a way, but you're using the life insurance company as intermediary. One of the cool things I like about whole life is, and I have a whole life policy, is that it is an asset, and you know that because I think statistics are over 97% of whole life it gets collected. So people don't throw away a whole life policy. It has true value. It's a true asset, and it has you have the ability to use it as collateral for a loan. So, and of course, any loan non-taxable, right? Loans aren't taxable, and that's way you can actually build up. It's tax deferred until you die, and once you die, it's tax free. So very much like real estate. Real estate, it's tax deferred, right? You're deferring your taxes through depreciation until you die, and then it's tax free. So the real estate and life insurance actually have a lot of comparable attributes.
They do. They parallel. That was a good example. So this is interesting. I always think about this, like when am I going to start dipping into the cash value? Because it's accruing here pretty good. And I'm thinking about it in the sense of a long-term rental. It would take a while to pay that back, right? Like the cash flow amount to be able to pay back the loan that I take off. It would take some time. I was thinking more of this for, I know you said it's more risky. Obviously, we talk about the different strategies, but like a fix and flip or just flipping a property in general, because then, when the outlay of cash, in 6 to 12 months, you could be replenishing that, right? Versus having to wait years. So what are your thoughts on that? Maybe give me an example of, a recommendation on a real estate strategy that you could use in parallel with a life insurance policy.
Well, let me give you one that I think would be in between those two, which would be if you bought real estate for short-term rental. Right. Short-term rental, one of the rules, the rule in real estate is the smaller piece, the smaller, the shorter the time frame for the rental, and the smaller the unit, the more money you're going to make per square foot. So that's why hotel, you got a small room in a hotel, but it rents for a lot more than an entire house. If the house is, you can rent a house for a month for a lot less typically than you can rent a hotel room for a week. Why? Because it's a smaller piece and it's a shorter time frame. So that's where your rent per square footage goes up. So that's why an Airbnb typically will rent at a higher rental rate per night than a long-term rental. So actually let's say you wanted to be in the vacation rental space, then using your cash surrender value for a vacation rental, you'll probably be able to pay that back faster, hopefully, because you'll have a higher, you have more rent than you would in a long-term rental. Now, that said, the long-term rental is less risky than a short-term rental because it's pretty easy to keep a long-term rental rented. You just have to rent it lower than market and get good renters in it. I mean, it's just not that hard to keep it rented. Whereas a short-term rental, you got to constantly be marketing it. You've got to have that turnover 2-3 times a week. If you're doing a fix and flip, first of all, I would make the point that fix and flip is not investing. A fix and flip is a business. And so it's very different. It's not an investment. It's a business because you're not holding something for time. An investment, you make money over time because of time. A fix and flip, you don't make money because of time. You make money because of effort. A business, you make money because of effort. So that's how I distinguish business and investment. Business, the money is made from effort, and investment, the money is made from time. So, whatever you're going to use, remember that you still have a loan. Okay. And you have to pay back that loan. And if you don't, you have severe consequences. You lose your you lose your cash surrender value, you lose your insurance, and you have to pay tax. So it is actually, I just want to remind everybody that is a true loan, and it's a loan from the insurance company. You're not lending it to yourself. It's not, I've heard life insurance called bank on you, having it be your own bank. It's not your own bank. It's not a bank at all. You are borrowing from the insurance company, and they will absolutely make you pay up.
Totally.
They will send Guido to make sure you pay up. So remember, they have no problem taking that insurance policy back, and they will in a heartbeat if you don't make your loan payment. So just know it's absolutely as risky as borrowing from a bank.
So let me ask you this. We talked about a couple different strategies that you could potentially use as an investment. I will say I do appreciate the distinguishing between investing and creating a business. We always talk to different real estate investors, and they're flippers. And I'm like, dude, you bought yourself another job. It's great for a nice lump sum of cash after all the effort.
It's a business. It's just a small business.
Totally. Now, in your opinion, and maybe if you don't have one here, it's totally fine. I know you mentioned the short-term rental space. We're invested in that space. We're in the long term. We've done a fix and flip. We've done an array of things here. But for me, I'm thinking this doesn't have to be real estate. Just using this vehicle, right? In chapter 7, I'm thinking of what would you invest in, or what do you see as common for people to invest in? Is it just real estate using this loan, or is there other things?
Well, I'll tell you what, I like I like not using it. And I know that's contrary to all my infinite banking friends, but here's what I like about a whole life policy. So let's say I have $1 million policy. That means that I've got $1 million that if I die, I can no longer produce income. My family's taken care of to $1 million, and it's tax-free to them. Okay. So there's $1 million of assets I don't have to be careful with while I'm investing. So what I'd rather do is have that $1 million be the protected assets, and then go use my other assets for investing. That's what I'd rather do. I don't like, nobody wants all of their net worth invested in risky assets. I mean, well, if you're 30, yes, that's fine. But if you're 45, 50, you don't want to do that, right? You want some safe assets. My favorite use of life insurance is have it be a safe asset. Everybody wants that asset where, boy, all else fails, I've got that money. All else fails, I can rely on that. All else fails, my family can rely on that. Now I can do, so that means that I don't have to set aside $1 million for my family out of my investable assets. I've got insurance. So I have to set that aside. So now my investable assets, I can fully utilize. And I like using and I don't have to borrow my investable assets. I got them. There's no risk there. I've got those investable assets. So I tend to use it that way more than I do borrowing against the cash surrender. Now, I'll tell you where it actually makes sense to use it for borrowing. And that's when, let's say that you don't save up enough money in even a year to make a real investment. So it's going to take you 3-4 years to save up the money. That's where it makes sense to save it up in the insurance policy. If you're putting away $2,000 a month, for example, okay, I'm going to put away $2,000 a month for 4 years. I'll have $100,000 in there. Typically, it takes 5 or 6 years before my cash surrender value I can actually use. Right? It's just building up over that 4 or 5 years, and then I can use it. But if I couldn't use it anyway, I might, because I'm not saving enough money, then it's a really good place to put it, because it actually is building an asset versus in the bank. It's just sitting there. It's not earning it. It may not be earning anything in the bank. I mean, right now you can earn something in the bank, but frequently you can't. And so then, okay, now I've saved up. Say I've saved up $100,000. Now I can actually go make a real investment. Okay, now that's fine. I just need to make sure that the interest I'm paying on that loan is less than the net rental income that I get on from the property I buy.
Sure.
So I just want to make sure that my tenants are paying my loan. That's really all it is. To me, it's like any other loan.
I see. So here to dumb it down even further, you're basically, let's just say you have the $100,000 in there and you want to use that as a down payment on a property. You put that down payment on the property. In theory, let's just say you're paying 4% on the loan or whatever the number may be.
Right.
You're basically taking the profit from your real estate investment and you're just dumping it back in, paying back that $100,000 over time, right?
Right. And now what I've got is now I have two assets, not one. I have the real estate asset and I have the life insurance assets. So I've got it. I use the same money for both. Right. But I've got two different assets and I like having, two assets to me is always better than one asset.
100%. I think you also had me thinking a little bit too here. So, people typically suggest 3 to 6 months of, what do you want to call it? Like a nest egg, if you will, or just like a protected account, right? You have liquid cash in case you need to be an emergency fund. There you go. I guess potentially that like 30 to 60 grand you have, whatever it is for whoever position wise they have in their finance. But like, say you take that out of your checking, you go invest that in something and you just are you suggesting potentially keep that life insurance as just, that's your, hey, rainy day fund. If something happens, I use that. Because more often than not, you don't touch the nest egg anyways.
Right. I like it that way. I like it as a, here's my safety valve.
That's interesting. Right? I might shift up. That's good perspective. Just it's so big. It's funny when someone tells you something that you already know, but like it's good. Peeling back the curtain. So it's I appreciate that. It's good. So I will say I appreciate you kind of, bringing it down to real life. A lot of things appear as super sexy and like, oh, this is a get rich quick scheme, if you will. And like everybody hears infinite bank, they're like, become your own bank. It's so sexy. And it's a tailored way to do it. It is incentivized. It is great in certain ways, but it's not going to skyrocket you. You have to it's just another vehicle, right? So I appreciate that. One thing I want to talk about as we kind of wind down here is your WealthAbility System. So we talked about the books. Can you talk about the WealthAbility System, what that is and how people can kind of frame it?
So WealthAbility is our education company. So our goal, actually our mission is to help people become financially independent of employers, Wall Street, and government. That's our mission. And what we do with education is more important than anything else we do. So if it's anywhere from, we have a weekly report, to I have a twice monthly webinar that's $97 a month. It's really cheap, but it's question answer, so you can get your questions answered cheap, and I'm answering the questions, so they should be good answers. And all the way up to we have online education. We actually have software that can help you actually develop your own wealth and tax strategy. And then we have a tax advisory franchise called TFW Advisors franchise, and TFW Advisors is tax-free wealth advisors. And then if you're interested in that, that's tfwadvisors.us. And that's our actual franchisees that I'm training on I got a question from one of our franchisees today. I get questions from them all the time. So they have access to me. I'm basically their national tax staff. They can come to me and ask me questions. And then I've got my own partners in my own CPA firm. So that's a way for people that really need kind of a higher level of sophistication in their tax strategy, that they can actually come to our franchisees for that. And our franchisees are typically CPAs who have some really good tax background.
So I think that's great. I did want to ask about that too. And I was going to ask at the end of the show or as we get down here, like how do you interview a CPA to find the right CPA for you, especially if you're a real estate investor? And we'll get there. I just want to put a pin in that for now. But for the TFW advisors, essentially you're going and coaching a bunch of different like tax offices, essentially your tactics, correct? And they know kind of top down how you run the show.
Right. So we look at it very strategically. We take a very holistic view. We want to know everything about your finances. We want to know about your relationship to money, your family's relationship to money. What do you want to do with your money when you die? All of that is going to impact your long-term wealth and tax strategy. We want to know how you make your money. What are you going to do with your money? And what are you going to do with your money when you die? And when we do that, then typically we're able to develop a long-term plan within 3 to 6 months that we're just constantly refining, right? So one of the things we do is we actually, the way we charge at TFW Advisors, we charge a monthly fee. We don't charge a project fee. We don't charge for tax returns. Tax returns are just part of the planning process. We're charging for the planning and including the tax returns in the fee because, look, if you don't have the planning, tax returns are just a pain, and you've got to do the tax returns. So we pretty much I always look at the tax return as the final step of last year's planning process and the first step of next year's planning process. That's how I look at tax returns as part of the planning process, not by themselves, right? They're not independent. They're part of the planning process. So you do need to have whoever is doing your tax advisory work needs to be doing your tax returns. Those two, you can't separate those two. That's a very bad idea to try to separate those two. I've seen people do it, and it never works.
It doesn't make sense to me, to be honest. It almost feels monthly fee, but it's like a retainer essentially, right? It's just real estate is a team sport. We all say that. And so for us, we have the same system going on our team. And it took us a while to find a good CPA, right? Because we really had to interview a lot of people because they say they know real estate investing, but when you start asking advanced questions, they're like, they don't get it. And there's like, we had a house, one of our properties burned down, and like going through that process. And there's not loopholes, but things you have to follow when you get a certain amount of money back. It's just like, it was interesting going through, and we had to pivot, and we've migrated like 3 different times, all the documents. It's so annoying. So that's why I wanted to bring it up. I totally agree with you. Having it all under one roof is amazing. I'm going to take it one layer deeper here because, as we kind of advance in our businesses, and a lot of our listeners kind of know our story too. And I say it's my partner, Corey, and I, we have real estate. We have 3 other businesses. One of us still has a W-2 job. So we're navigating this whole whirlwind of things. And so it comes that we also weave in, or the conversation comes in, is like our business is structured properly, and how does this flow into taxes? And so we had another gentleman, I'm not sure if you're familiar with him. His name is Mark Kohler from I believe it's Main Street Tax I think he's out in Utah, but he's awesome. And he dumped a ton of knowledge on us. He made me really thinking about different things on like inflow and outflow of money and how you should frame it. But I think that's the next level for us. And I'm just wondering, from a gentleman who's been in the game for so long, do you guys take care of that? Do you have liaisons that kind of can help you get the structure of your business properly, because right now it could be all over the place?
Yeah, we actually do. Well, so we always help our clients build a team. Like I say, it's team sport, right? Mm-hmm. So that means you need an asset protection attorney. You need an estate planning attorney. You need a life insurance agent, frankly. You need somebody to do cost segregations on your properties, right? So we actually have these vetted people that we work with, that we refer people to. I've spent years vetting these people. I've learned the hard way that the fastest way to lose a client is to make a bad referral. So I do my best not to make bad referrals. And so we're very careful about who we refer our clients to. But we do work with them. So I'm a big believer that the attorney and the accountant need to work together. It can't be, they can't be pointing fingers at each other. And it needs to be strategic. So, and it can't just be tax. This is where I think other tax advisors make a huge mistake. They think it's just tax, and it's not. You have to look at, what are you going to do with your money? What's the wealth building side of it? If you don't include the wealth strategy in it, you're leaving 90% of the money on the table. Yeah, you can do all your tax tips and tricks and that kind of stuff that those guys do. But I think you're leaving most of the money on the table. So yes, you do need to structure it properly. You need to have an attorney involved. You need to make sure your accountant and your attorney are talking to each other. And you need to make sure that your accountant has been properly vetted as well. That's challenging. I mean, we had a network of accountants, like Kohler does. We had a network like that. And what we found was that, you can't control it. You can't control a network. That's why we went to a franchise. We're the first franchise. And the reason we went to a franchise is because we can control a franchise.
So explain that a little bit further if you could.
So a franchise, so we're the franchisor, which means that the franchisee, they're literally part of our system, and they have to follow our rules, else they lose their whole firm, right? They don't just say, well, I'm just not part of that anymore. They would lose their whole practice. Okay. We're joint. We work together. We're partners. Okay. We are business partners with our franchisees, and it's a much tighter association than a membership or a network or something like that. So we've actually gone to a very tightly controlled network because we had a loose network. We were actually not as loose as some, but we had a loose network, and it's not tenable. It's not tenable. So you either have to have a big firm or a franchise. I mean, to me, those are the only two logical systems.
Totally. I think, thanks for breaking that down, by the way. I think the relationships matter a huge amount to people too. Like when you go to certain people, and not a franchise, but like, let's just call it the network, right? You go in and you just get passed around every 2 years to someone else. Like people want to, like, I want to know, and I know it's not going to be directly with Tom because your time is limited based on all the things you're doing. But for example, like someone in your firm and in one of your franchises, like I'm looking at this, like Michael, for example, like I'd want to know I can call Michael and just have an answer to the question versus having to like get passed around all the time. And like having that relationship is key. I don't know.
Well, and I'd go one step further. I said, one of the nice things about a franchise is, let's say that you're with one franchisee and you feel like you outgrow them. Well, you don't want to leave the system, right? You still want the same same thought process, the same training, all that kind of stuff. But with a franchise, you can actually move to yet a different franchisee, and you're not really losing anything, because what you're doing is you're just moving to another person, but within the same franchise system. And I think that makes a big difference, but you get to choose that, right? You're right. You shouldn't, that's the thing I don't like about the big firms, is they do pass you around a lot.
They do. And I think for us, just relationships matter. But Tom, I respect your time, and this has been an amazing episode. Thank you for dropping so much knowledge on us. As we kind of close out the show, how can people, if they want to network with you, potentially look at TW Advisors and kind of like get into your scheme of like building wealth and bettering yourself, and maybe they're real estate investors, and just how can they get to the next level of relationship with you and network with you?
Well, if you just want to get some basic education, I'd go sign up for our weekly report on wealthability.com, and that's free. I write that twice a week. And I'd start there. If you want some questions answered, sign up for our WealthAbility Live. If you'd like to go to an advisor, first of all, read chapter 23 of Tax-Free Wealth, because it's how to find a great tax advisor. And then if you want the easy button, go to tfwadvisors.us.
There we go. Tom, this was an absolute pleasure. Thank you so much for being on the show. Corey, unfortunately, couldn't be here tonight, but I know he's going to be jealous that I got to hang with you for an hour. So you are super knowledgeable on the topic. As I mentioned, one of the godfathers in the space. And it was just a pleasure to have you on, and I thoroughly enjoyed our conversation. So thank you very much.
My pleasure. Thanks, Ryan.
Thanks for tuning in this week to the Wealth Juice Podcast. If you liked what you heard, please leave us a 5-star review on Apple Podcasts, subscribe, and share with friends. The more ratings we get, the more ears we'll get on our show, and in turn, we'll be able to provide you with more high-quality guests. You can also find us on Instagram and YouTube at Wealth Juice Official, where we post daily tips, tricks, and document our own journey towards financial freedom.